Welcome to our quarterly webinar. For those of you that are new that perhaps haven't attended it in the past, really what these webinars are designed for are CFO and controllers. We want to bring quarterly webinars that are pertinent to your specific operations and what's going on in the market. And so, with everyone just having finished their audit season and close out 2014, we thought this was a really good time to present really the results of 2014, both from a financial and operation perspective. And so you can see kind of where the market is and where everyone is at compared to perhaps some of your results. So to introduce myself again to a live audience this time, I'm Trevor Reinhardt. I'm a senior manager of the advisory services department at Richey Company. So for those of you that may not know, we kind of formalized our business advisory department a little over 2 years ago. It's made up of 4 of us, and really our goal there was to continue to bring value and added services to our clients. So I'll touch on a few things. I won't bore you too much, but for those of you that may not know some of the things we're doing on that, I'll touch on it a little bit. But without that, we'll kind of get started. All right. So the information that I'm going to be presenting was pulled directly from Richey Select. Those of you that may be unfamiliar, Richey Select is a tool we built. It's a financial and operation benchmark tool. It's built specifically for independent mortgage bankers, and our goal there is to deliver quarterly results directly to your desktop. We have, we present all the major models, and really the key to what we do is we custom build a peer group based on the specifics of your company. So your operating and your production, and the goal really is to give you the closest peer group that's available to you, so you can see your results stacked up right up against your peers and make kind of real-time decisions based off of that. So some highlights from what we're going to take a look at today. It includes over 40 lenders, and as a benchmark, we will have over 50 when we release Q1, which we're in the process of doing right now. We're going to present all the operating models. The average production of the clients was $1.5 billion from 2014. I showed average Pretax income of 23 basis points. 2014 was marked by some increased margins overall, certainly some increased expenses. One of the things I wanted to draw your attention to, you'll see throughout this process, you'll see top select performers. And what those are is we've taken, they're kind of the best of the best. So what we've done is we've taken the most profitable companies, regardless of size and model, and we're going to present those results alongside all the other models, so you can really see kind of what's going on and what the best of the best are doing in the market. Some other terms I wanted to draw your attention to is one of the things you'll see throughout is Q5, and that's just kind of Richey Select presents quarters standalone, and so Q5 is really our year-to-date. So anywhere you see Q5, just think year-to-date for 2014 or 2013, and then anywhere you see the word complete, you'll see Richey complete, and that's the average of everyone in this everyone that's included in the survey. All right, so just to take a look at some rankings, we're going to take a look at production and pre-tax profitability, but you can see kind of where the numbers, and you want to keep these in mind throughout the presentation. But wholesale mix, the reason we use mix there is because it includes companies that have at least 50%, but most companies have a blend, and so yeah, wholesale is a little bit more difficult than some of the other kind of traditional peer groups. So wholesale mix includes lenders with at least 50% of their production in the wholesale, and they came in at $2.17 million. To give you some reference, that's down from $2.43 billion last year. Our top select performers came in at $1.85 billion, came down a little bit from $1.87. The average of everyone was $1.5 billion. The retail came in just under 1.4, and direct consumer came in at 1.182. Now, taking a look at profitability, obviously the top select performers, again, our criteria is profitability, so this is pre-tax, but they came in at 53.3 basis points. The retail lenders came in at 30. The average pre-tax profitability is 23 basis points. The wholesale came in at 13.5, and direct-to-consumer unfortunately has had some hard times over the past 2 years, and while not significant, they still came in at a loss of 8.3 basis points. Everything, all the following slides, what I'll do is I'm going to show kind of year-to-date, so the 2-year average, and then I'm going to show kind of a rolling 8-quarter average. So we'll present different views of everything as we go. So just taking a look at total production by operating model. So the first we have is the Richey Made Complete. So this is the average production. And on average, lenders noticed an 8% decline from 2013 in total production. The top select performers, I believe, had the smallest decline. They still had a decline, but it was 1%, so just a little bit better than average. Retail Complete came in at 2% decline for the year. Again, the direct to complete, like I said, they've had a very tough year that we'll look at throughout, but they had a 30% decline from 2013. And then lastly, the wholesale mix showed an 11% decline. And so this is just kind of looking at how each peer group trended over the past 8 quarters. So again, quarterly results going back to the first quarter of 2001. The trend line is based off the Richey Made Complete. So, you know, we're showing that it's going to remain relatively consistent. The trend line's going down a little bit, but it's going to be, you know, based on what we're seeing, relatively consistent. You know, I did want to point out that the MBA is projecting a 9% increase in total originations from 2015, and so, you know, that came from the March 20th, 2015 mortgage finance report. So I don't think that I've not seen any updated reports beyond that, but those come out at least quarterly, but I think they do come out monthly. So you can keep an eye on that and go from there. I did have a question. Someone asked me to restate the wholesale mix. Again, the wholesale mix is if lenders that have, on average, lenders that do at least 50% of their production in the wholesale channel. And so the other 50% is a myriad of other things, but that one's a little bit harder to get kind of 100% true wholesale lenders. There's not as many out there as there used to be, and so that's what the wholesale mix is. So what we're looking at here is total production. So we're looking at not only total production, but the breakdown of purchase versus refinance production. So the first column is going to be 2013. The second column would be 2014. What we're seeing for 2013, the purchase business amounted to 64% of total production. In 2014, that rose to 75%. But as we stated, total production went down. So even though refi in 2013 was 36%, and like I said, purchase was 75% in 2014. So refi made up 25% of total production. So we're continuing to see the trend of it being a purchase-driven market. We have seen some periods that so many spikes in refis and some of that, but generally it's 75% for 2014 it was kind of the mix for everyone. And again, this is just looking at it over 8 quarters, and it's showing what purchase. Again, this is percentage purchase versus refi. So you can kind of see what it looks like from there. Next, we're going to take a look at an actual income statement. So what I'm going to do is I'm going to show the individual models. So these are the averages of everyone. So I'll show them kind of one by one, and then we'll take a look at them side by side. So what we're taking a look at should kind of follow what your audited financial statements look like, and your internal financials as well. So the retail, as anticipated, it really has the highest personnel cost of all peer groups, and that came in about 293 basis points, which is up from 284 basis points in 2014. Now, of that 293, basically 120 basis points went to LO compensation. On the retail group, they did have a minor decline in origination revenues from 2013, but more than made up for it with increased secondary gains. So the wholesale mix, and again, I'll show these all side by side, and I'll give you a little opportunity to take a look at them. But pre-tax earnings in this group dropped by 16 basis points, and that was mainly due to for the Q1 and Q4 of 2014 not being so great for them. And so, Q2 and Q3 were actually pretty good, but overall they dropped 16 basis points. So the direct peer group, again, they're the only peer group with a loss for the year. Q1 through Q3, they were actually running at pre-tax income, but for a variety of reasons, Q4 had a very significant loss of 87 basis points. So that really wiped out the earnings that they had from Q1 to Q3. And this is just taking a look at the complete peer group. I'm going to skip over this one, and we'll talk about it when I pull up all of them. And then, of course, the top select performer. What's interesting with them is they really are going to be the middle of the pack from a revenue standpoint, but they had very, very good control over expenses. particularly what you'll see is, and I'll go ahead and pull it up. What you'll see is, they had very, very good control of personnel costs. So they came in almost 20 basis points less than the average, and almost 33 basis points less than the retail peer group. And so you can see kind of side by side. I would we'll look at these in more detail, as well as some of the expenses, but you can see kind of where margins are at for each of the various peer groups. All right, so let's look at gross loan margins for a little bit. So this is going to be origination fees, net of your direct cost to originate, and as well as secondary marketing revenue. So as we'll see, average margin increased by basically 18 basis points, which is 4.8% from the prior year. So this is the average we're looking at here. Went from 368 basis points to 387 basis points. The top select was in 368, so it tracked right along with the peer group. I mean, it really did. They really did track along with the average. So 368, 387. There's minimal difference there. The retail peer group was consistent with the prior year with only a minor increase. So I mean, we're seeing a trend where there was an increase, but it really was pretty minor. The direct peer group had the most significant increase at 87 basis points, and I think that's more of a statement of a poor 2013 than really a strong 2014. And the wholesale peer group was the only group was declining, so their margins went down just about 24 basis points. So again, looking at it over the 8 quarters, the margins were pretty stable in 2014. There was really only a 13 basis points from their highest point in 2014 to their lowest point in 2014. Average margins over the prior 8 quarters is amounted to 378 basis points, and that is again overall peer groups. And then we're anticipating stable to moderate margin growth for 2015. Again, we've seen through from Q1, we don't have all the full results, but in talking with clients, a lot of clients have had a very, very strong Q1, and so margins are up, production's up. So hopefully, that we'll be able to continue on, to Q2 and Q3, which are in the purchase-driven market are really the traditional busy time. So hopefully Q1 is not an anomaly, and it's really showing that we're going to have a strong 2015. But based on kind of what numbers have done, we're thinking a little bit of growth there. I'll just go ahead and pull up all these. So these are operating expenses in basis points. So on average, operating expenses increased from 75 basis points in 2013 to 87 basis points in 2014. That was really, and we'll get into this a little bit more, but what you'll see, is really cute. The first quarter and second quarter, all operating expenses ballooned as a percentage of total production. Q3, they really remained stable, and then Q4 we saw a shift in where lenders were spending their money. I'll talk about that in a little bit more, but it's really it's a 14% increase compared to only an 8% decline in production, and the increase was universal across all operating models. So I just touched on this a little bit, but the good news is prior to Q3, the third quarter, based on the line items that were actually increasing, it was, lenders didn't really have a good handle on their expenses. So Q1 and Q2, all their expenses were expanding on a cost per loan, and not consistent with obviously production, but not consistent with revenue. So lenders really didn't have a good control, and that really affected the bottom line. When Q3, so the beginning part of the third quarter, kind of followed that trend. Towards the end, they had really stabled off. So we saw no significant increase in expenses per loan in Q3. Now Q4 is an interesting one in that the cost per loan in basis points, it did increase, but the line items that were increasing were items such as occupancy and equipment and non-loan officer production support staff. And what it really looked like is that in Q4, lenders spent all of 2014 getting their expenses under control. They felt pretty solid about it, and in Q4 it looks like they're spending kind of investing in the future. So they're adding branches, they're adding support staff, and so what we typically see is that increase in spending is going to precede any increase in production. And as I said, Q1 so far, from what we've heard, production's up. And so, it no longer looks like lenders don't have a strong hold on their expenses. It looks like they understand kind of what their baseline is, and they were able to make some decisions during the fourth quarter to say, all right, we know where we're at, we know what our spending is. Let's go out and let's increase it. Let's drive up production. And so it'll be interesting to see, particularly in the first quarter, if those if the expenses begin to trickle down a little bit as a percent, in basis points, and if production, and like I said, anecdotally, we are seeing that. So we'll take a look at operating expenses. So as I mentioned, where lenders are spending their money. So on the left is the occupancy. So I've switched from basis points to dollars per loan. So occupancy is up to $637 per loan from $534 in the prior year, and that's basically a 19% increase. Technology remains kind of a relatively small piece of the puzzle. It did go up 26% to $150 per loan, but still remains a small portion of it. Professional fees. So this is going to include outsourcing. It's going to include professional services. Anyway, that increased 19% to $172 per loan. Marketing and advertising is $440, so 17% increase. This is, if you can remember back to the income statement, this is somewhat larger than because of the direct lenders that are in there, but still a fairly significant investment. And the G&A is up 12% to $474. So even though there wasn't a remarkable shift in how lenders were spending their money, the overall cost per loan increased in 2014. So in other words, the pie pieces didn't necessarily shift. The pie just got overall bigger. So costs increased to $1,873 in 2014 from $1,597 in 2013. So that's a 17% increase in expenses, total increase over year over year. Well, obviously, we are excluding payroll from this and just looking at kind of the true operating expenses. So this is an interesting graph we're going to take a look at. So this is what we're calling profit margin. So profit margin, you take your gross loan margins, deduct operating expense and compensation expenses. So when you look at it, it's really how much of a dollar do you have left, once you pay out the cost to operate and pay your people. So it's a percentage of revenue dollars used for compensation operating costs. So with the exception of the wholesale, this is the only peer group, the retail, with a year-over decline in profit margin. And again, it's very slight, but it is there. Again, I've talked about it a couple times now, but the direct lenders have had a really difficult past 2 years. So 2013, they were losing money. Basically, they were losing money on every transaction. And even though they had a remarkable improvement in 2014, they're still the lowest of all peer groups. And also keep in mind that they were also the lowest in production. So, that's one of the selling points of a direct is you may have low profits, but you make up for it with significant volume. Well, over the past 2 years, that's not held true. It's a shift in the market, and I know direct lenders are out there and finding new ways to do business and trying to reverse this, but that really is a significant number there. Here we take a look at the wholesale group. It's about where we expect. But they did, going back real quick, they did have the largest decrease in profit margin at 34%. So that's overall peer groups. The industry average, so this is the complete we're looking at, 3 basis point increase, so 2%. So basically they're right in line with where they were last year. And then just taking a look at the top select, I mean, you can see this really does show why they really are the top performers, where they have so much money left over after, they have such a large profit margin built in that they're able to take it to the bottom line. And so this is kind of where the conversation comes in, your margins versus production and how that comes into play. So clearly the top select performers really have that dialed in. I mean, their profit margin has not changed significantly year over year. They're up there with the wholesale group in 2013, but still the leader in the clubhouse. So, and what we saw for 2014 is, the break-even profit margin was just over 13%. So basically, 87 cents of every dollar could go to your operating compensation expense, and you would still basically break even with everything else that was in there. And then just kind of trending over time. I think with the exception of direct, let's take that out, but you can again see why they've had such a hard time. Even though I mean, the trends really are following pretty consistently amongst all peer groups. Again, taking out the direct. So even though they're varying degrees of steepness, the overall trend really does follow. And so it really does go into talking about that built-in profit margin and where that goes. Because if you have that dialed in, it moves in concert with expenses and production and everything else, and you can remain profitable even in lean times. And then again, the top select, obviously, you know, they're the only group that consistently stays over the trend line, and again, the trend line's the average. So pre-tax profits, you know, the average pre-tax income was between 22 and 23. I think it came in right at 22.7 basis points, so the average of everyone in the peer group. Top select, again, they average almost 50 basis points, 49.3 over the past 2 years, and as I said, they came in at 53 this year. The retail group, and I don't think this is a surprise to anyone. You know, it's a purchase-driven market. That's what retail lenders typically excel at. So aside from obviously the top select, they had the highest profitability at just under 30 basis points, which was down slightly from the prior year, but still a pretty respectable number. And then again, our friends in the direct complete, even though they had an 85% increase the prior year, they're still at a loss, barely, but still at a loss. And then lastly, we'll take a look at the wholesale group. Their profitability declined 55%, down to 13 basis points. And again, kind of, I mean, as you'd expect with the profit margin, we took a look at what you're seeing is the trending over the prior 8 quarters. So Pretax, you know, what we're seeing is we're expecting it to be somewhere in the neighborhood of 10 basis points. Again, I think that number is pretty low given what we've seen in the group, but that's what it's projecting out to right now. But again, take away the direct to complete, everyone else follows the same basic trend pattern. It really just is how dialed in they have their margins. And you can see, you know, the retail group, they touch kind of the top select performers on 2 points, and so they really are. They do trend pretty well with it. Just kind of that fourth quarter of 2014 really set them apart. So kind of summary, there was a marginal increase in gross loan margins, a minor decrease in total productions. Expenses increased as a percentage of production all of 2014. But do keep in mind there was kind of that shift throughout the year, and so I fully expect to see Q1 to see that expense number come down on the dollar per loan basis. As production and profitability increases. So kind of our current analysis based on kind of current production, so that was current, you know, through Q4, revenue and expenses. Company should be somewhere in the neighborhood of 30 basis points pre-tax income right now. So again, that's significantly different than kind of the trending indicates, but this 30 basis point number is based really on the most current data. So that's kind of where we expect to be. I did have a question about the direct complete. So just to kind of clarify that, the direct lenders, what I'm referring to is the direct to consumer. So these are, your internet-based lenders, but they really are focused on high volumes, and there's a variety of ways that they get it out: TV, internet, direct mail, some of those items. But that's what I'm referring to when I discuss direct lenders. And then, like I said at the beginning, we for the past 2 years have formalized our advisory services, and so I just wanted to take a minute or two to introduce a few things and talk about them. But we've recently added a cash flow and financial analysis tool, so that allows us to take your current financial and production data and project it forward. We can do shock analysis based on change in production, change in margins, and a change in both. It can be used quarterly, monthly, annually, or to prepare and fine-tune projections. So it is really a very useful tool where you can see, here's our analysis, here's what happens if production increases or decreases, here's what happens when margins go up and margins go up or go down. But really it allows you to kind of see the impact before you make any decisions. And I think this lends itself very well to what I was talking about, kind of fine-tuning your built-in margin and what the market will allow and what it looks like to your bottom end. And if you can get that really dialed in, how you can take that built-in profit margin straight to the bottom line. The other thing that we're actively working on right now is, I wrote it in there wrong, but mortgage operation appraisal program, well, not review program, but appraisal program. We call it MOPE. But really it's a financial and operational review of the organization. We're able to concentrate on your areas of concern, and we take a long time talking with you and understanding that and understanding your pain points and where you're seeing the issues, and we dig into your company and really help you fine-tune and make your company effective and efficient going forward. So we can do that organizationally, we can do it by department, or even just functional areas. So, accounting, obviously, given what we do, we can take an in-depth look at your accounting department and make sure it's operating exactly how it should be. So again, we're focused on improving profitability, effectiveness, and efficiency. The key to it is, it really is a highly collaborative approach. We're talking with you and reviewing documents and customizing it as they go to really help you understand where you're good, where you're not, and what you can do to kind of make the next step in your organization. So lastly, certainly thank you for your time today. I hope you found some good information. I will be happy to send out the slides to everyone that was on the call today. Certainly, if you have any questions on the information that I presented, or you'd like to get some information on how to get this delivered to you quarterly, email me, trevor@richeymay.com. You can visit richeymay.com or our traditional website, richeymay.com. There's plenty of information on there. And that's really all I have today. Like I said at the beginning, we do these quarterly. So I would definitely look forward to, one, at the end of July, beginning of August sometime. And as always, if you have any ideas or thoughts about information that you would like to see provided, please don't be shy to let us know. We happy to fine tune them. Sometimes we do them ourselves. Sometimes we bring in a third party. It really just kind of depends on the topic and what we're after. So again, I appreciate your time. I know that everyone is busy right now, and please let me know if you have any questions. With that, I will sign off, and you guys have a great rest of your day. Thank you.